Hi friends, welcome back to the channel. This is Financially Wise Canada, where we bring you curated financial information targeted to the Canadian audience. Our goal is to share personal finance and investment information so you can make financially wise decisions. Please remember to subscribe to the channel and like this video. Today, we bring you the top 3 Canadian dividend growth stocks and reasons why we think they are undervalued. Before we jump in, please remember to do your own research or speak with a licensed financial professional. The first stock is TFI International. This is the largest trucking and logistics company in Canada and the 4th largest in North America. They are known for acquiring smaller trucking and logistics companies and integrating them into their larger operations, making them more efficient and tapping into their existing customer base to expand market share for TFI International. However, in the past few years, they spent some major dollars in acquisitions that have yet to show profits. This caused them to have a major price correction during December 2024 from $218 to $103. At current levels, it has already passed the 50, 100, and 200-day moving averages. This is because some of the acquisitions they made are now starting to show profit and contribute to the growth of the overall company. TFI International has a $12.8 billion market cap, pays a 1.65% dividend, and has a 28 PE ratio. With debt of only $4 billion compared to the $12 billion market cap, this number is fine and not a cause for concern. If I click on growth and profitability and then the revenue tab, you'll see that revenue has been growing steadily for the past few years since 2018. They generate revenue from a few segments like less than a truckload, logistics, package and courier, and waste management. However, they have completely exited the waste management side of the business to focus on other more profitable areas. This chart shows the number of acquisitions made by TFI International over the past few years. 7 in 2024, 7 in the 2023, and so on. This was the major source of debt accumulation of the past few years and the reason for the stock sell-off. However, the new acquisitions are coming online and generating profits, and so the price is moving higher. They just hiked their dividend by 4.4% and are seeing exciting growth in their new data center logistics division. Their next earning report is mid-February, and results are expected to be positive. Analysts rate TFII a strong buy, as it still has a lot of room to grow to get to the previous price of $218. Let us know what you think about this stock in the comments. Next up is Canadian Natural Resources. Price is below the previous high with strong technical and fundamental reasons to move higher. CNQ is considered to be the king of the Canadian oil patch, and for good reason. They are powered by massive cash flow and a reputation for operational excellence. For income investors, it's a beast. This is a $100 billion market cap company that pays a 4.89% dividend yield. Price to earning ratio of only 15.2. They have increased their dividend each year for the past 25 years and is a true dividend aristocrat. However, don't ignore the risks. A dip in oil prices could pull the stock back, as the higher the price of oil, the higher the profit. However, lower oil price can cut into its margins. The next earning report is in March. CNQ is a premium hold for long-term income. Investors can consider getting in a small position now and buy the next dip more aggressively. Let us know your thoughts. Remember to visit our website and our personal finance app at financiallywise.ai. Free to use so you can manage your budget, track your investment portfolio, debt management, savings goals with guided help from our AI, calculators, and more. This is basically your full financial picture in one snapshot with the ability to do some stock research. Next up is Gildan Activewear, who has been unstoppable lately, trading near all-time highs and proving the clothing business is anything but boring. The big story? The Hanes Brands acquisition. This move massively scales their operations and cements them as a global leader in everyday apparel. Wall Street and Bay Street are loving the synergy. However, the stock price has only moved in a cautious tone with positive expected earnings report. This most likely will shoot up as the price has been hovering at a potential breakout entry point. Analysts have rated this stock a strong buy. Other research papers suggest that this Canadian company will be a new giant to dominate the apparel landscape, taking market share from other big brands like Nike, Lululemon, and Adidas. With low downside estimates and a significant expected upside, this company should be on your watch list for sure. Apparel market can be tough with tight margins, but if your product is of good quality at a great price, you'll have the lion's share of the market. Gildan is an $11 billion market cap company with a 1.42% dividend yield. PE ratio is only 20. The report earning late February. So there you have it. TFI International for the trucking and logistics play, Canadian Natural Resources for the energy, oil, and gas play, and Gildan Activewear as being a new dominant market maker is activewear. Which one will you pick? All three? Let us know.